After the 2008 crisis, the obscure market for derivatives, the over-the-counter market, has attracted the attention of several central banks and regulators, given that it contributed greatly to the severity of the crisis. The OTC market is obscure because all the operations are done between the two contractors and no one else. AIG, for example, had a pool of CDS of more than 1 trillion in notional value, and nobody knew this but them and their counterpart. These contracts didn't require AIG to set apart some amount of money like they do with insurance contracts. So when everything collapsed, AIG was at the center of the black hole. So today, companies that want to enter in one of these contracts have to do it through clearinghouses for their own safety. These intermediates have deposits from both companies to assure that when the time comes, should the payer doesn't pay, the deposit is used to pay the obligation. Luckily for the capital of the UK, the largest clearinghouses are based in London. Besides the clearinghouses, London is the home of a dozen pan-European trading venues and dark pools which use their passport rules to trade around the EU. London accounts for about half of the 600 trillion over-the-counter market, and about 40% of the world's currency trades are traded here. More importantly, around 90% of the euro-denominated derivatives contracts are traded and cleared in London. But why has this city become such an important financial center? London has historically prospered from misguided regulation being applied by other countries. For example, in the 1960s, the US passed capital controls to tax investment in foreign countries, creating the euro-dollar market in London. Additionally, London has always been investors' favorite due to English law. Unluckily for London, the UK is leaving the EU, and everyone is afraid. But why? The UK will lose its passport rules, so trading firms may have to set up new offices in continental Europe to cater to two sets of customers. The leave vote might entail shifting these derivative contracts into an EU-based clearinghouse. These are not good news to anyone. For users, clearing is expensive, but banks and brokers claw back some of that outlay by posting margin to back their derivative trades at the same clearinghouse. This is an incentive to keep derivative trades inside one clearinghouse, since it's cost-effective, an advantage that would erode should the houses split between a UK and EU jurisdiction. Peeling the euro out of the clearinghouse will increase the cost of clearing and fragment the risk. It would damage and balkanize the market. Leaders in the EU, especially in France, Ireland, Luxembourg and Germany, are calling not only for the euro-denominated market to move to their cities, but also for the whole market. They want their financial centers to become the new London. As we can see in this graph, the UK accounts for half of the interest rate derivative turnover. LCH SwapClear is the largest clearer for derivatives, owned by the London Stock Exchange Group. Given its grandeur, this firm is the real target. However, the threat of moving the market as a whole should be unutterable these days, since it is anti-competitive to insist on a specific jurisdiction for trading and clearing. Until now, no asset manager has yet announced it will shift its headquarters away from the city, but fund companies are finalizing plans to reduce their reliance on the city. Now we have to wait until Article 50 is triggered, the process through which the UK will legally leave the EU. And then the negotiations will start, and everything will depend on what they settle. Let's hope that Brexit doesn't harm the economy once it's complete.